And hello to everyone. How are you doing?
So yeah, well, here in Germany we have Good Friday, so it's kind of a bank holiday, so very slow day, to be honest. But
Yes,
still,
yeah.
we had the release of the Non-Farm Payrolls today.
Yeah,
and
that was
and
very.
I just realized that only FX pairs are tradable, so not even precious metals like gold are tradable.
No.
I weren't aware of that. I thought
Yeah.
that we probably have at least some action or something like that.
Yeah.
But still, I think we can draw some interesting conclusions out of what we just seen in terms of non-farm payrolls, but also in terms of the other releases the days earlier, so ISM and so on and so forth. I think this is quite interesting to draw a picture and then take it from there.
Absolutely. So very excited for your session today. I'm sure they're going to get a lot of value, whoever is going to have the chance to participate right now. So
should I share my screen?
You are trying to share your screen in 2 seconds. Yeah, try now, please.
Yes, there we go.
By the way, Vincenzo made €1.5 today. Yeah, just to make sure. It's in a pretty much nothing on the go to make money today.
I mean,
the big thing.
It's still good. I mean, it's still positive for the day.
Yes.
So that's greener than me.
Well done, Vincenzo. Well done. Okay. So the stage is yours.
Yeah. So taking it from there. So hello, and I welcome you to today. As I already said, I was kind of surprised, to be honest. So I was aware that today equities are not traded. That's something, or the equities are not traded. That means spot. So stocks can be traded. We see some trading taking place in futures right now, US equity futures. So German DAX is closed. And I thought, well, at least there's some action to be expected in terms of gold and precious metals. And then I just realized I was looking at the chart and just like, well, it doesn't move. So why doesn't it move? And then I found out, well, precious metals are close today too. Still, I think it makes sense, and it's probably even better to have an idea right now, even though we don't really know how gold will react. I think we can definitely have a look here at the developments around FX pairs, draw some conclusions out of what just happened, also of what happened over the course of the last days, and then also paint a picture or create a game plan for next week, especially when markets reopen. That will be then on Sunday evening, respectively night, GMT. So something like, I'm not even sure, to 22, 23 or something. Then we take it from there. Probably we'll get to see a small gap, depending a little on how the market is reacting right now, in terms of yields, especially. The interesting thing is I can already take it now, or say it right here. So numbers came in as expected. So, and interesting enough, now expectations of the Fed hiking rates increased by 25 basis points, hiking rates by 25 basis points. Which is kind of interesting, to be honest, because this is naturally something which is usually not that positive for gold. I have to say, probably this release is even better for gold, because I'm quite bullish, to be honest. I think we have a good and serious chance to rather sooner than later see an attack up to the all-time highs. But with the numbers right now, and yields are seeing some kind of spike higher expectations in terms of Fed rate hikes coming in higher now. You can quite clearly spot then if really bulls step in, and if bulls step in now and hold gold above 2,000, then it's probably a very, very positive sign, given the numbers and after the recent break above 2,000. But before we start, first of all, let's have a look here at the risk disclaimer, and please be aware that risks, when you trade the markets, there's risks involved, and there's a high risk of losing money, especially when trading leverage products. So make sure that you understand the risks, that you find out your personal risk profile, then also check out whether this risk profile corresponds with the risk profile which you find when trading FX, respectively CFD products, leverage products. In this context, test it out via demo, and then taking it from there. What I present to you today are my thoughts. If you say, well, this is interesting, I want to use these thoughts here for a trade hypothesis, and you make a trade based on that, please be aware that you're taking full responsibility and all risks involved with the trade. So this, what I present to you today here, my thoughts are for educational purposes only. And please, again, make sure that you understand all the risks. Read the risk disclaimer carefully. You find it on admiralmarkets.com. Check out the website for further details here. Download the demo, see yourself whether this product suits your personal risk profile, and then taking it from there. And in regards to the introduction, you will also find all information around Admirals on the webpage, admiralmarkets.com, for further infos on the DAX offering, or also in addition, FX offering, precious metals, stocks. Just check out the website for all details. And fully regulated broker, that's probably a very important point you note. Fully regulated means offices around the globe and several regulatory bodies overseeing the business from Admirals. So for getting a full overview of all regulations, check out the website. And then let's jump, there we go. Let's jump into some theory before we then head over to what we're currently witnessing in the markets after the release of the non-farm payrolls. So first of all, the theory, I want to make it as simple as possible. It's quite rough, but still you get an idea on the theory behind why the employment situation is of interest for us and why it's always important to keep the numbers here in mind. It's not just the non-farm payrolls, which we'll cover today, but also in addition to that, we had an indication already on Wednesday with the ADP data set, which was released. Usually this is a positive correlated release, and numbers came in significantly below expectations. So it's kind of interesting to see right now that the non-farm payrolls came in as expected. It's nothing special, in fact. So but after such a weak release on Wednesday, some might probably have expected, me included, by the way, that we probably get to see a release which comes in below expectations too. In addition to that, there's also other ways to cover the employment situation. For example, it's the JOLTS. For example, the JOLTS, because the JOLTS are the job vacancies, which was, by the way, the main trigger for the bullishness in gold and the push above 2000. That came faster than expected. And I was, by the way, trading that. So the break got higher, and unfortunately, there was no follow through on the upside. I will present to you the trade probably in more detail in a few seconds then, which I took. I had a buy stop above the highs, and I thought that probably we'll get to see some kind of drift towards that level and then probably consolidate, getting tighter below the breakout level, and then get to see the push higher on a more, let's call it more important news release like the non-farm payrolls. But we got it already on Wednesday. Interesting enough, we didn't see a follow through, even though numbers around the ADP and also ISM non-manufacturing, and here the paid prices component also, that's probably which is of interest in terms of inflation, but also the employment numbers. They just disappointed. They came in significantly weaker than expected, which is usually a sign that the Fed will potentially not continue hiking rates as the Fed did in the past, respectively, with the monetary policy path that followed here for now quite some time to bring inflation back under control, because obviously it's hurting the overall economy. The interesting thing about this is now that gold didn't walk through on the upside. That was one of the reasons why I took my first, let's call it the momentum trade with a breakout above this level, why I took it out. And now what's of interest for me is I want to see whether the non-farm payrolls, respectively, how we react now after NFPs come in as expected. If this is a sign that we will keep on holding above 2000 in the next week then, and with a start, and that will be of interest. I think if numbers came in below expectations, usually we would have seen a push directly straight higher and a move up to the all-time highs. Now the question is, after these numbers were released today, as expected, can we hold the breakout? If we can, then I'd consider this to be a sustainable break and then continue to play the long side, even though it probably will take some time and need a newer fundamental catalyst like the inflation data, which will be released on next Wednesday. But this is something we will cover in the future. Today, we will cover the non-farm payrolls. And the question we have is, why are employment numbers of interest for us as traders? Why is it, especially in the current environment, a very important news release? So again, very roughly speaking, if you have an overall stable environment, especially not just economic-wise, but also political-wise, then if there's confidence, then usually you see factories pushing up their efforts to produce goods. We are talking about the manufacturing sector, not the service sector, because it's easier to understand. It's quite straightforward, let's say. You see an increase in orders, so factory orders, which is also a news release, which is covered each month. They are usually going up. There's a clear trend on the upside, because, well, why do you want to see an increase in industrial production? Very simple, because there's naturally a higher demand for products, because people are more optimistic about the future. Simply speaking, let's say, well, you just got married and you have a family, and now you're building a house, and now you have to buy furniture and all that stuff. Simply speaking, well, this is only a step you take, not getting married probably, but buying a house and settling down. Once you look into a prosperous future, if you have a trust in your employer to keep you employed, and to make sure that you will have a job tomorrow too, make money, make ends meet, and you're looking you're looking optimistically into the future, simply speaking. And that being said, now means that the higher demand here for let's say manufactured goods, but also non-manufactured goods, but we are focusing on the manufacturing side here. The higher demand has to be met here from companies, and this is exactly what companies do. So they invest more, they produce more, they hire more people. Well, this is what they have to do to meet the demand, to build the products. It's nothing like I don't know, social media or something, or right now with artificial intelligence, for example, where you see a lesser demand for workers because there's a great chance to reduce costs for your employer in terms of your employees by using artificial intelligence like ChatGPT, for example, to answer very complex questions or something like that. And so what you will make sure is that you have the best, and probably also that you have many employees. And how do you make sure that you have many employees? Well, simply speaking, you have to pay them more money, or you have to pay them relatively attractive to make sure that these guys will work for you in the future. And that means that you will usually also get to see where you pay them more, a higher salary, which means like you get to see an increase in average hourly earnings. This is also a number which we will cover in a few seconds, and you will see being covered in this news release from the Bureau of Labor Statistics. And so what does it mean if more people have work and getting paid attractively and have higher wages, or there's higher wages being paid? Well, naturally, you have people with higher income. The more money, the more people have more money, well, and the more optimistic they look into the future, the more usually people will consume. This is also true in terms of like if your investments go up in value, like if you have a well-diversified investment portfolio, and it's running well, or respectively it performs well, and you see or you have at least the feeling it's only on paper, but still you feel just richer if your stocks move up in value. Well, this is usually then something where you say, well, I'm richer and I can afford this, and this is usually a sign that consumption goes up here. and there's a higher propensity to consume. That's what I'm talking about here. And well, what does it mean? Well, it means that the economic growth continues to push higher. There is economic growth, and well, naturally, usually this is what you get to see. You have a rise in inflation because the higher demand, if the demand is there, you can hike prices as a company and say, well, pay me more for the good you want to have so badly. Right now, as you might have seen, we have an environment in which this is not given. Where the funny thing is, let's put it that way. The funny thing, or what we get to see, is there's a solid development in terms of the employment situation, but I don't think that we all agree, at least on a great outlook for the economy at all, given the recent numbers which we got to see. People, or not the people, but economic growth is obviously diminishing while inflation is quite high. The reason for inflation being high is that we countered the COVID pandemic and the lockdowns, which obviously didn't make sense at all. We covered this several times. It hasn't changed my opinion here in this regard. It was just the worst way to manage this whole situation. And you kept people at home and kept them silent by just handing out, for example, stimulus checks, for example, and just flood the economy, respectively, flood the market with more liquidity. So more QE in this regard. But the lockdowns also interrupted the supply chains, which means there was lesser goods being produced while there was more money chasing these fewer goods, which means, well, inflation rises. It's not because there's a natural process of more people being hired to produce goods, which are then bought with higher wages, or from people who are getting paid higher wages, and due to an optimistic outlook in the future. But the inflation raises due to the fact that there is more money chasing fewer goods, while the overall economic outlook isn't as positive as especially politicians want to make us believe, let's say. So they are straight lying to us, especially in the US. I think I've seen that several times. It's sometimes really, to be honest, it's sometimes really ridiculous what we get to hear here from the representatives from the White House, for example, at these press conferences. So it's like as if they're not really yeah, well, I'm not really sure. So, I mean, it's obvious that something's going terribly wrong in the US there. And no one is really covering that, but instead of covering it and addressing it and finding solutions and listening to the people and the feedback they receive, it's more like they are trying to hide, or especially, or it's not really that they hide, but they answer the questions in a way that you just think, okay, well, obviously they don't really even realize that there might be a problem. But whatever the reason is there, what we get to see right here is that there's not the economic growth or the optimistic outlook in the future. Right now, probably also the tensions, rising tensions between the US and China, for example, in regards to Taiwan, for example, but also the support from the Chinese now in terms of Russia and in terms of the invasion in Ukraine, for example. So I think it was yesterday or within the last days that the French minister Macron went there. And I'm not saying that, but he said, let's say he's an ally from the U.S. As the French prime minister, and so he urged Xi Jinping to not to deliver weapons to Russia or support Russia in terms of the war in Ukraine, and Xi Jinping just said, "Nice that you say that, but." I don't think that I need to listen to you here. So that was simply translated what you just said. And also in addition to that, he was still open to talk to Zelensky, if I'm not I'm mistaken. But I think Zelensky reacted in a way that he said, I don't want to talk to Xi Jinping. Well, for whatever reason, but it's a fact that there's building tensions between the West and China, and the West represented by the US, And so in addition to that, there's also now more and more signs that the Fed is obviously losing credibility. So that's also something to make sure to understand. If the Fed and their economic projections tell you that at the end of the year, they are expect where the FOMC, the Fed, the voting members here expect the target rate to be 500 to 525 basis points, while the Fed Watch tool now shows us that the expectations are 400, 425. So it's 100 basis points lower than what the Fed just told you the rates will be at the end of the year. It's a clear sign of mistrust. It's like, well, you can tell us whatever you want. You can't keep rates at the current level. You have to cut them if you don't want to destroy our economy. That's what the market is telling the Fed, and that the Fed is not trusted anymore. Especially probably after now all the developments in the banking sector. But long thing short, so usually what you see is heating up in terms of inflation. We're going to get to see that. It's not due to the classic way that there's some optimistic economic outlook, but it's due to the interruption of the supply chains and so on and so forth, and that markets were flooded with liquidity as a result. And so now inflation got out of control. They had to hike rates, as they did. Central banks, respectively the Fed in this case, they hiked rates to avoid an overheating of the economy, even though there is no real overheating right now, but it's like a quite difficult outlook, let's say. And signs of a recession are quite clear to be seen for a long time, by the way. So you can already see that when you just look at the yield curve and see an inversion here with higher short-term yields, 2-year yields, for example, and lower longer-term yields. So there's an inversion of the yield curve. Why is that? Well, there's a high positive correlation of short-term yields to the Fed and what the Fed is doing. So if the Fed says we are hiking rates, we continuously hike rates, that means that you push short-term rates higher. But if you, let's say, overdo it, and if you're hiking too aggressively, that means that you're, it's not that you're destroying the economy, but the outlook for the economy worsens. Which means if you have short-term higher rates, longer term, you expect a recession, respectively, a cool down of the economy, at least. What does this mean? Well, that means that the Fed has to cut rates. So longer term, market participants are saying, well, we don't see elevated yield levels, which means short term, you push the rates higher, and longer term, you push them down, respectively, the expectation drops, which means you have an inversion, that you get higher yields short term, while you get lower yields longer term. And this is the idea behind this. If you have this inversion, this is usually a very strong sign due to the size of the bond market in general. So long thing short, this is what we got to see. Now there's other interpretations, definitions of a recession at the horizon. For example, there's a very simple definition, like you have 2 quarters in a row of negative economic growth. Then once you're coming back to the White House and their representatives here, they were asked about this, and it's like, well, this is a quite clear definition, and we are headed to, probably we are already in a recession. So what do you say about this? And then it's like, well, we have another definition, and they came out with another definition of a recession, which was kind of funny, because the guys who came up with the definition, that was the Harvard Business School. So if the Harvard Business School is coming out with like recession can be defined as 2 quarters in a row of negative economic growth, and then the White House says, well, that might be that they define it that way, but we define it in another way. That's kind of interesting. But again, so this is what we are currently in. And now the thing is, right in the current environment, we expect the Fed to react in some way. Or let's say we have these signs of a cool down in economic growth. You see, based on this simple way here, and roughly speaking, that obviously the employment situation gives a straightforward way where it's kind of a mirror of how the overall economy is doing. So long thing short, if the employment situation worsens and the numbers come in better or worse than expected, well, then usually you have a sign that the economy is doing worse than expected, which means that, well, you expect the Fed to cut rates and vice versa. So right now it's more like, if the employment situation worsens, then usually you expect rates to go down, which is usually positive for something like gold, for example, because gold is a yieldless investment, and also it's negatively correlated, for example, to the US dollar. So if you're looking into a future where you expect the underlying, well, in fact, it's kind of a stock of an economy, if you want, the currency, and it's the US dollar here, and people are expecting the Fed to counter the economic downturn with a looser monetary policy, respectively, with floating markets in terms of another round of QE, for example, with more US dollar, which means like an increase in the overall US dollar supply. You expect the underlying currency, in this case, the US dollar, to go down. If you have it negatively correlated to something like gold, you expect gold to go up. That's a simple way to put it. And so let's have a look here at the Fed Watch tool. I already mentioned it, and it's a screenshot which I took several minutes ago and before the non-farm payrolls were released. So this is interesting because this changed now. You will see what I'm talking about. You can currently see here with each column, you see the likelihood of where the target rate will be or is expected to be here at a certain point in the future. And what you can see here is that you can go, let me just head over here to the website, and let me just share the link so you can play around with it yourself a little. Let me just call it the Fed Watch tool. So what you can do is here, you can, for example, say, okay, I'm now interested in seeing where is the market expecting the target rate to be at the next Fed meeting, which will be at the 3rd of May, for example. So one month from now, around. Or you can say, well, this is May. What is the market expecting the rates to be at the June meeting, for example? So in the next, where also the PDF is released in terms of the economic projections, and so on and so forth. And what you can see here with the columns is right now we are at 475 to 500 basis points, and you can see that 500 to 525, you see that this is currently the highest column here. And that means that the market is expecting the Fed to hike rates by 25 basis points in May or in June, which is kind of surprising. So they're not quite sure whether we will see that now in May, or probably will pause in May due to all the developments in the banking sector, and then hike rates by 25 basis points in June. But at least we will get to see this rate hike. This is at least what the market is expecting. This is surprising because right now, or not right now, but we all witnessed it. So we made it a topic here in several webinars in the past. We had tensions in the banking sector, and one of the reasons for the tensions in the banking sector is that there was a too restrictive monetary policy path the Fed followed over the course of the last months. So right now, after all these tensions, you expect the Fed to pause, else they potentially cause problems for the overall, in this case, the US banking sector. Right now, the market says, well, obviously everything's under control. No reason to worry here anymore because obviously, well, we somehow saved Silicon Valley Bank, or to some extent at least Signature Bank, and so on and so forth. The tensions in the overall banking sector disappeared, or at least they're not as strong as they were around 1 month ago. And now, well, to fight inflation, numbers are expected to cool down further in terms of the overall inflation rate, which the numbers will be released next week on Wednesday. And so the Fed can continue to hike rates to cool down inflation and bring it down back to around 5%, and then probably further lower from there over the course of the next year, probably the next 2 years, to the target rate around 2%. But you can also see, if you continue to click through these tabs here, you can see the market is expecting the Fed to hike rates by 25 basis points, but then the likelihood increases, and we're here at above 60% for July. This is 1.5 months later that the futures market is saying, well, and then we expect the Fed to cut 25 basis points. And we expect the Fed to continue to cut by another 25 basis points. In this case, so we are now around 50%. And then we expect in November another 25 basis points. And then in December, we expect the target rate to be, with a likelihood here of over 60%, at 425 to 450. This is interesting because now, and this is now where formulating a game hypothesis comes into play, and why the market, in this case, only the FX market, due to Good Friday and due to the fact that only FX pairs are traded today, and what to make out of this in terms of gold. But what you can see here is it's 425 to 450. And coming back to my presentation here, you can see that before the NFPs were released today, this column here was highest at 400 to 425. So the market right now, based on this employment numbers, they're expecting the Fed to hike rates by 25 basis points. I think this is, it's surprising. To be honest, it's really surprising because it's only one news release, which is from today, and it's one where I would say, well, it's not as good as you expect the numbers to be honest. So having a look now at the numbers, we have non-farm payrolls for March, 236,000 was expected to come in at 230. By the way, let me just share one chart I found in the morning, and which I shared with some clients here. So that's from Bianco Research, I think. This is also a great follow on Twitter. And he shared this Bloomberg chart. And I think this is very interesting because you can see here, it's the median estimate, it's 235,000. And numbers came in as expected, as I already said. So if you look here at 236, this is like what the market expected. Unemployment rate 3.5 and so on and so forth. But what I think is very interesting is to see what is the market really expecting. So the big banks. And here, these columns, this is what investment banks. So this is like Bloomberg or Reuters calling banks and their analysts who are covering, in this case, non-farm payrolls, and then asking them, hey, what do you expect in terms of the non-farm payrolls on Friday? And they rank, or they collect these data, and then they sum it up. And they say here, for example, around 250,000, there was 17 banks which came in around 250,000, and that was by far the highest column here, while all the other banks came in somewhere here. So like I think, to be honest, this is in fact a disappointment when you look at the pure numbers. If you just look at how many jobs were created here, I have to say, well, the numbers itself is not something which is positive, and it's somehow underlying that we're or underlining that we're that we see a cool down in terms of employment situation. So that's what I make out of this. And this is underlined by, for example, looking at the ADP data set, which came in on Wednesday, it's 145. But also, if you look, for example, here at the ISM non-manufacturing numbers, these were released on Wednesday. We had the manufacturing numbers already on Wednesday. That was the same tendency. The numbers came in below expectations. So here, numbers were expected to come in at 54.5, coming in at 51.2. So, well, still not in a recession here. So the key is at 50. Let's say that this is the number. Everything above, simply speaking, is the economic growth or we're seeing growing economy, while if we see a drop below that level, this is pointing towards a recession, simply speaking. And we see a clear cool down here. We see a clear cool down now for around 1 year, and continuously pushing lower after this massive reversal here following the COVID pandemic and this breakdown on the downside. What's even more interesting here in this regard is that you see also factory numbers, for example. So there's some, we call them subcomponents. I'd like to look at these two. So for example, paid prices, you see at 59.5, for example. Previous, it was 65.6. There's also a clear, I wouldn't call it deflationary process, but there's a cooling down in paid prices. If prices are coming lower, well, inflation is obviously cooling down, which means that the Fed is not forced to fight inflation as aggressive as the Fed fought inflation over the course of the last year, especially, which is, by the way, one of the reasons with hiking rates that aggressively, as we've seen, that the equity markets, for example, drop massively. And you see here, it's not that we are falling off a cliff, but there's a clear trend lower. But in addition to that, it's not just that inflation is cooling down, but also like new orders, for example. Look at the previous numbers, 62.6, now coming in at 52.2. Inflation, or I'm sorry, the employment component here in the non-manufacturing sector, 54 previously, now at 51.3. If we look at new orders, for example, we did worse. I mean, there was this massive break lower something 2-3 months ago, but well, we're, as you can see, it's not that we are seeing a clear trend on the upside or a positive tendency, but it's like it's lower highs. In the current environment, especially with new orders here coming in lower than expected, this is usually not a sign of a very strong economy. It's just an indication, certainly, but it's not that I would say, well, this is like strong economic growth. So putting all this together now having a look here at the chart. So this is now dollar JPY. We don't need to look at gold, for example, because there's no movement at all. So there's no move because market is closed. So nothing to see here. But when looking at for example, Euro USD, but also like dollar JPY, for example, and this is something which is of interest. So if you take something out of this presentation, because you now say, well, it's interesting, well, great, but to be honest, like, yeah, there's no real movement in the market. So what can I do out of this? Well, if you want to take something out of it, then make sure that you understand that there's, for example, a positive correlation between dollar JPY and 10-year yields. So we can already use this as an indication to what expect on Monday for gold, which I consider to be of highest interest in the current environment. In a few seconds, you will see why. But you can see a push higher here. And this push higher, which we got to see, is underlining what we already saw in the Fed Watch tool, that now rate hike expectations increased. And why can I say that, or why do I want to say that? Well, because I know, looking here at this chart, I know that dollar JPY, which you can see here in candles, is positively correlated to this orange line, which is the 10-year US yield. So this is the yield you're getting paid for holding 10-year treasury notes. And so what does it mean? Well, it means like if these yields rise, you expect dollar JPY to rise. If they drop, you expect dollar JPY to drop. So what we've seen here is that there was this, let's call it the takeoff that was in March, around 1 year ago. It was in March 2022. You see, well, that's a little unfortunate. It's not optimal, but I hope you can still see it here. So you see that there was a large increase in 10-year yields. We took off there from, I'm not really sure what this was, but something like 2.5 or something. Whatever it was, we saw a massive increase in yields, and this pushed also dollar JPY higher. And then we saw this correction, let's say, this drop. We saw a pull in here in yields, took off again, pushed higher, and now we're seeing here a top out in terms of yields, because the market is expecting the Fed to cut rates rather sooner than later. We see this pull in here in terms of yields, and this is also driving dollar JPY lower. So it's only roughly speaking. But if you take this information and now you look here at the chart, well, you can already see, well, we popped higher. We are not taking further momentum on the upside. And this is, by the way, something which now lets me come to the conclusion we are likely to see another flush lower on the downside in gold on Monday. Let's go here to the chart so that we get to see a flush on the downside. But the question will be, is the breakout we got to see here on Tuesday, is this a real breakout? And there's several signs which you could already see yesterday. It wasn't that there was a massive volume taking place, but this is a 50-minute chart now on gold. You see here, this drive higher, this momentum drive higher, that was driven by the jolts on Wednesday, which came in lower than expected. I think the lowest level since September 2020, if I'm not mistaken. Same idea in terms of the development cooling down in the employment situation. Why do I say that? Well, if we have a look here at the United States, it's not that you find under labor jolts, but you have to know what jolts cover, and it's the job offers. And simply speaking, it was May 2021, but it came in below market expectations. And you can already see it here, job opening. So like, imagine you're running a company and you're hiring people and you're looking for people. Well, what do you do? Well, you look for them. So it's like, well, we offer a job to you, so please join us. If you start to reduce your efforts here, probably because you're looking into a not so nice future, because you think, well, there's a cool down in economic terms, for example. Well, the job openings will continue to drop. We are still massively elevated, let's say, if you look at the developments we've seen here following the COVID pandemic and over the course of the year 2021. But still, this is an indication that the economy is cooling lower or cooling down. And this cool down in terms of the jobs market could be seen here in terms of the jolts. And it's one of the reasons why we got to see this push higher, in my opinion. We continue to push higher. And that was, by the way, let me just probably go here to an hourly chart. That's probably a better way to put it then. I had a buy stop here. Probably not that optimal, to be honest. I was already thinking about here into this, let's say, call it curl up or something, to buy a long position, because there was let's probably do it that way. We've seen a rising wedge or triangle, probably we can call that. And then there was this flush lower that was on Monday. What happened there? Well, remember, there was this surprising production cut from OPEC Plus in terms of WTI. If you cut oil production and see a spike in oil prices on the upside, well, usually you expect inflation to pick up. Inflation picks up, you expect the Fed to be more restrictive. More restrictive means yields pick up. Yields pick up means gold should spike lower. And this is exactly what happened here. But then something very interesting happened. We saw a very strong reaction. So we're already holding higher lows here in this regard. And once we broke this trend line, which formed here, but buyers stepped in and pushed us aggressively higher. And Monday we closed at the highs. That was a clear sign that we're potentially breaking higher. And I was already thinking about this here earlier that day, and then completely caught off guard, let's say. So it was so quick. I was triggered here for the long trade, for the buy stop, which I just had in the market, and just in case, and the case just happened, because then numbers come out, and I hadn't it on the radar that this is the trigger. So I knew, yes, jolts will be released, but it wasn't that I said, well, I expect jolts to be the trigger for the push higher. Well, as you can see, we pushed higher, and then things got interesting, and that's one of the reasons why I started to be a little more skeptical, let's say, because that wasn't what I wanted to see. I wanted to see a straight through walk through on the upside, and then a push up to here, this red line, which is covering the all-time highs. And we didn't walk through, despite the fact that ADP came in below expectations, despite the fact that ISM non-manufacturing disappointed, as we just went through several minutes ago. And you see here, there was a pop higher that was now, if you zoom in here, you can see this candle That was on the release of the non-manufacturing data set. And we didn't break higher, but we had everything in place to break higher. We didn't. And that was the reason why I took off the trade initially. I said, well, this is not very good because you have everything in your favor right now. Breakout, hold above, weak economic data, drop in yields. So, well, why is there no walkthrough on the upside? If the market is not walking through, this is usually not a positive sign, at least initially. And then I took out the position with a small profit, something like $15 or something, 15 USD per ounce then, and then multiplied with what I traded here on the breakout. And we saw a flush lower, but that was interesting because we flushed below, or yeah, in fact, we flushed towards 2010. Just put it here. So this is like on point and bounced. Okay, that was interesting. I didn't take a long position from there. I was out and realized the price action. The next morning, I come in, look at the chart, see, okay, some weakness in the Asian markets, popped lower again, drifting higher. Again, buyer stepping in. It's not on point, but it's only a small spike below, and then we see buyers stepping in. Then that was yesterday. I wasn't on the desk yesterday here on Thursday. Didn't see that, but I saw the bounce again. So it's not that it was just like a wick lower and then we popped higher, but we pushed again here and closed solid, let's say. The interesting thing now is, well, we are forming lower highs, and all in all, weak economic data wasn't able to push us higher. This is usually a sign which, let me come to the conclusion now, probably takes another economic driver, for example, in inflation data on Wednesday, to push us then up to the all-time highs. Looking at the right here at this price action, well, it makes it likely that we are gapping lower on Monday, coming in somewhere around 2000, probably 2005, around the close. Depends a little. I don't really see. I look here at dollar JPY, while, for example, when looking at the Euro USD, for example, you can see, well, yes, also there's some USD strength, again, negatively correlated towards the gold price. And we are trading slightly below where we started, but it's only 15 pips, right? So this is the NFP candle. It's 109.11. It's 109.11. Right now, we're trading at 109. So it's 10 pips. It's nothing. It's like as if the market didn't move at all, because it's also that numbers came in as expected. Again, there's a way stronger reaction when looking at dollar JPY here right now. Let's see how things play out now over the course of the next hours. I don't really see much movement at all. Again, what I could what I expect right now is we come in lower, somewhere here around the lows. If right here around 2000, straight away buyers step in, I consider this to be a sign of strength. It's not that I'm going long against that level. I want to see a further confirmation, but if buyers step in, and we are then breaking here this trend line, which formed of the lower highs and going back above 2010 and see a closing price above that level, I would say that's a strong sign. And then I want to be long gold, risking against the lows, which we formed then around 2000, and aiming for new all-time highs. If this doesn't happen, we gap lower, drop 2000, close below, well, then probably takes some further time. And I'm still very positive on gold. I still could imagine that we are about to see a push up to the all-time highs in, well, probably the next weeks. It depends now a little on how we come in on Monday and how we perform against 2000. Buyers step in, pushing us and letting us close for the day above 2010. I think this is a strong sign, and that we are about to see a quite dynamic push higher, probably triggered by the US inflation data. If not, well, then it takes some further time. So this is right now my play for the days, something I thought about, and that's it. In fact, yeah, it's perfect. Vincenzo just said goodbye and happy Easter. So that's exactly what I wish you now. Happy Easter. I hope you enjoyed the webinar. I mean, well, price action is very well, not given at all. What we are witnessing right here. it's fully concentrated on the FX markets, and even in Euro USD, there's no big volatility happening right now. A little more here in dollar JPY, but even here it's subdued action. And now let's just see how things play out. I think the key event on Monday and the most interesting market is definitely gold. Let's see how we perform against 2000 and then take it from there. So I think it's straightforward. We drop below, we hope below 2000. Well, long is not an option anymore. We drop towards, probably flush slightly below, and then see buyers stepping in, and we close the day, Monday in this case, above 2010. That's good. And a reason for me to become very interested in a push up to the all-time highs. But let's see. So that's it from my end. All the best. Happy trading. Watch your stops. Happy Easter. Talk to you again next week. I really look forward to it. See you. Bye-bye.